The crypto market is bleeding, US stocks are ripping, and BlackRock is quietly trying to drag trillions of dollars onto the blockchain. While traders panic over Bitcoin slipping in a scary jobs narrative, Wall Street is lining up its next big on-chain play. In this video, we're breaking down the macro storm hitting crypto and why BlackRock's tokenized ETF push could be the catalyst that changes everything. Today's sell-off in crypto didn't come out of nowhere. It hit right after fresh US jobs data and revisions that changed the entire story of 2025. The latest non-farm payrolls report showed the economy adding about 130,000 jobs in January, with unemployment ticking to 4.3% and average hourly earnings cooling to around 3.7%. On the surface, that looks like a still resilient labor market, but the revisions tell a darker story. According to analysts digging through the data, more than 1 million jobs were effectively erased in revisions, turning big chunks of 2025 into what some are calling a hiring recession. Job growth looks narrow, driven heavily by sectors like healthcare, social assistance, and construction, while government payrolls actually fell, and several other industries showed flat or negative hiring. That kind of low-hire, low-fire environment suggests the Federal Reserve may have kept policy too tight for too long, which keeps traders on edge about growth, inflation, and risk assets. Crypto felt it instantly. Bitcoin dropped below the $67,000 level, with major altcoins like Binance Coin and others sliding as open interest stayed compressed below $100 billion, far off last year's highs above $255 billion. Sentiment has flipped back into extreme fear, showing that for now, crypto is acting less like digital gold and more like a high beta risk asset that gets hit first when macro jitters show up. Here's the twist. While crypto is selling off, US stocks are in full risk-on mode. The S&P 500, NASDAQ, and Dow all opened sharply higher, led by big tech and growth names, as equity desks talk about broad-based strength across US large caps. Yet at the same time, Bitcoin is trading around the high 60K area, down roughly 2 to 3% on the day, with Ethereum and Solana down between about 3% and 4% over 24 hours. That divergence is the key story for traders. Desks are calling crypto the purest expression of macro risk appetite, but it's also the first place investors cut when volatility or uncertainty spikes. Even as stocks grind higher, total crypto market cap has faced back-to-back daily declines, and altcoins have been hit hardest as traders rotate out of leverage and into safer exposures. Add in rising geopolitical tensions and speculation about a potential US strike on Iran, and you get a market where oil and traditional safe havens like gold are bid, while Bitcoin is proving once again that it is not yet treated as a true safe haven asset. Now, while this macro storm is raging, BlackRock is quietly laying the rails for the next phase of crypto adoption. The world's largest asset manager is in active talks with the SEC to tokenize its flagship iShares ETF lineup, turning traditional funds into blockchain-based tokens that can trade 24/7 and plug straight into DeFi. BlackRock CFO Martin Small has said the timing is uncertain, anywhere from roughly 90 days to 12 months, which tells you this isn't just a thought experiment. Tokenized iShares would effectively transform mainstream ETFs into programmable, on-chain collateral that can be used in lending, structured products, and other DeFi primitives. Industry voices like Matt Hogan are calling this one of the key narratives that could lead the market out of a bear phase, arguing it's very positive for Layer 1 blockchains and the DeFi sector as a whole. Think about the scale. BlackRock's iShares franchise already sits on trillions of dollars in assets, and the firm has seen explosive growth from vehicles like its iShares Bitcoin Trust ETF, which rapidly grew into one of its most profitable funds. If even a slice of that ETF universe moves on-chain, DeFi gets not just more TVL, but higher quality yield-bearing collateral with real-world cash flows behind it. So what does all this mean if you're trading or investing in this space right now? First, the macro link is not going away. Crypto is still trading like a leveraged side bet on global risk sentiment, and data like jobs reports, inflation prints, and PMI surprises can flip the tape from greed to fear in a single session. Second, The fact that crypto is under pressure while Wall Street rallies doesn't automatically mean the cycle is over. It may simply reflect short-term deleveraging, ETF flows, and nerves around Fed policy and geopolitics. But underneath that noise, the infrastructure is changing. BlackRock pushing to tokenize iShares ETFs is a signal that the next wave of adoption might not come from memes and speculative altcoins, but from regulated institutional-grade assets migrating onto public chains. That shift could create new demand for base-layer blockchains, fresh use cases for DeFi, and a bridge between the trillions sitting in traditional finance and the liquidity-starved on-chain economy. If you're in crypto today, you're trading two stories at once. The short-term macro drama, jobs, inflation, Fed, geopolitics, and the long-term build-out of tokenized real-world assets led by giants like BlackRock. The volatility you're seeing now might just be the price of admission. If you want more deep-dive crypto macro breakdowns like this, make sure you hit subscribe and turn on notifications for BlockNexus TV. Drop a comment with your take. Is BlackRock's tokenization push bullish for crypto, or just Wall Street trying to own the rails? And as always, this is not financial advice. Stay safe, manage your risk, and I'll see you in the next episode.